2020 is over, and what a year it was. Hello, my name is Freitag, National Director for Hospitality Market Analytics for the CoStar Group, and today I will discuss with you the single worst year in the US hotel industry's history. When the WHO declared a pandemic on March the 11th, the impact on the hotel industry in the US and globally was swift and severe. Corporate transient demand, corporate group demand, and leisure travel basically stopped overnight. We can see this clearly in the RevPAR drop for the month in April, which declined by 80%, the single steepest drop for any month on record in the 30-year STR history. It was eerie to say airports empty and hotel lobbies without guests. Luckily, the American consumer took to the roads in the summer of 2020 and brought much needed relief to some hotels, mostly in markets that offered access to either beaches or national parks or simply wide open spaces. But this demand was often not enough to prevent temporary closures and layoffs for many employees. With room demand decreasing sharply, occupancy followed suit. Ultimately, STR recorded that the year-end occupancy stood at 44%, a 22-point drop from the 2019 results. Now, most of you remember that 2019 was indeed the single best year that the hotel industry ever recorded. So the results of 2020 will take quite a while to repair, especially since these low occupancies gave hoteliers almost no pricing power. The impact of the complete stop in corporate group and meeting demand was most sharply felt at the high end of the market. Upper upscale hotels recorded an occupancy drop of 52%. Limited service classes did somewhat better. In the economy segment, for example, occupancy declined by only 17%. We take this as a clear indicator that the American consumer, when they did finally go on their much needed road trip after being sequestered at home, chose roadside hotels or cheaper accommodations for their travels. Overall, RevPAR for the upper end of the market declined by over 50%, whereas for limited service hotels, RevPAR declined between -30% and -50%. It is clear that the recovery for the upper end hotels can only happen after mass vaccinations and mass immunizations take place. Vaccinations are a clear focus of the federal level now, and the expectation is that later this year, travelers will once again be comfortable meeting, going to conventions, and meet in conference centers. The segmentation data that STR produces shows the sharp drop in group demand and RevPAR. In April, group RevPAR declined 94%, and that number has not really recovered since then. It is our expectation that there will be an increase in group room demand in the third quarter of 2021, but that of course hinges on the rollout of the vaccines. The absolute occupancy chart paints a dark picture, as high-end hotels only recorded less than 4 in 10 rooms occupied, whereas the limited service hotels showed an occupancy of just under 50%. These low utilizations then led to distress as owners could not make their debt service, and some high-profile hotels in New York City or Washington, D.C. closed permanently. Despite the very poor performance on the revenue side, developers continued to open hotels. Indeed, over 1,000 hotels with over 120,000 rooms were delivered in 2020. We currently count 190,000 rooms in construction, and most of them will be delivered in 2021, likely putting even more pressure on occupancy going forward. On the transaction side, only $20 billion transacted, the lowest level since 2009, and less than half of the last few years. Deal volume would have been even lower, but for 2 blockbuster deals. On Valentine's Day, Blackstone closed its deal with MGM Growth Properties for a 50% stake in the Mandalay Bay and MGM Grand hotels in Las Vegas for a total of $2.3 billion. But that wasn't the largest deal of the year. In July, VICI Properties acquired a 7-property portfolio of hotel casinos in New Orleans, Atlantic City, Las Vegas, and other cities for $3.2 billion in a sale-leaseback transaction with Caesars Entertainment. So our outlook for 2021 is of course much more positive. It really seems that the worst is indeed behind us. For 2021, we expect that RevPAR will increase by over 20%, but that increase is actually driven by room demand, not by ADR. It's going to take us quite a while longer, probably until 2023, until ADR reaches 2019 levels. In the meantime, if you have any questions, please email me or check out our market analysis product in the CoStar product available to subscribers. Thank you very much for watching. Until next time, I wish you well. I wish you health.